that might be an overstatement, but sure. Let's go with that. I'm all organized.
Okay, so here we are again. So I'll start off with what I was just mentioning. I think the first thing we need to have a look at is the increase in the stability fee that's passed, and I think also acknowledge the fact that, Rich, correct me if I'm wrong, or anyone else correct me if I'm wrong, but this is the most votes that we've had so far. It was something in the region of 90-odd thousand.
I think it was the most votes and the most quickly voted as well, which was really nice to see.
It really is, and really kudos to everyone. Thank you very much for participating. It's starting to feel like it's getting the momentum it needs. I know that there are folks out there that are still trying to get their custodianship in line, and they're trying to get their regulatory perspective in line. And once they've got that, we should see even more coming to the governance portal very soon. So on that basis, we passed the stability fee, and we've only had a couple of days of data. So there's I don't know if that's sufficient impact. So my first question is, does anyone have any evidence as to if this stability fee has had the impact we've hoped for?
I definitely think that we cannot really, we've not been able to see any sort of particular change in the direction that things are going, as far as I'm concerned. And later I have a bunch of data points I want to, I can point to.
Okay.
But yeah, it would be interesting if someone has something positive. Yeah, that would be really interesting to see if someone can actually think of some example.
If there's anything that anyone wants to bring to the fore, because what we've seen isn't really enough evidence to actually tell us anything conclusive yet. I think maybe we need a couple, obviously a little bit more time to see how this sort of plays out, and we can come back to you with what we understand and put forward further suggestions. But I thought this would be an opportunity to give anyone on the call who wishes to put forward any metric or any instant change that they've seen to maybe acknowledge it. But if not, then we can.
Well, I think DAI is still trading significantly below $1 right now, like in real time.
Mm-hmm.
Still right now.
What would you say would be the sort of real exchange rates that you look at to sort of come to that conclusion?
I'm just looking at the order book right now.
On where?
What?
On which exchange?
All of them.
Yeah. So the what I think is kind of, what I also think we can start focusing more on. Even though it has very low liquidity right now, I think that the DAI USDC market is very interesting because it's just so obvious, it's just so obvious that we should never ever see DAI sell orders below $1, right? Like sitting as sort of limit orders, which, and I'll just post the link here. If you go have a look, you can basically see that people are willing to sort of market makers are actually selling DAI below $1. And I think that's one of the fact that there's clearly that imbalance there. So it just really looks like DAI is valued below $1. Probably is also a reason why the market doesn't even catch on at all, right? Because there just isn't the condition there for liquidity to even emerge.
Yeah, I haven't looked super closely, but something that I thought was really interesting a few days ago was USDC in real time trading significantly above $1. It was $1.01, and then $1 and 1.5 cents, and it seems like as of right now that is the gold standard in stable coins right now, just in terms of what liquidity providers are interested in making markets on. Even you can probably see it right now, on Coinbase on ETH to USDC and Bitcoin to USDC. You probably get more bang for your buck using fiat right now than you do with USDC, and that's just really interesting like data point that everyone can look at right now and say, what are they doing right, and how do we get to that point? You know,
that's also just super irrational though, because you can you literally switch 1-to-1 on Coinbase. But that's why that's why I think DAI USDC in Coinbase, right? I mean, that could really just be taken as like, here, if DAI is probably priced here or whatever, or if there's good liquidity here, you will always be able to, if it's stapled there, you can arbitrage from there to anywhere else, go through USD, right?
I mean, until there's a savings rate attached to actually owning DAI, logically it should trade just slightly under $1 always.
I disagree with that. That's not. I mean, it's really a matter of the total, like the aggregate supply and demand, right? I mean, if we increase, if we just jack up the stability fee now, don't worry, we'll hit a point where DAI becomes overpriced. But yeah, the question is, anyway, so definitely I think there's probably no one who doesn't agree that it still looks underpriced, and I think we should not sort of be like, let's push for another vote, tomorrow or something. That would be just like a bad precedent, right? But I think definitely we, there's just a strong argument for making sure that we keep going until we start sort of feeling out where is this equilibrium point, right? Because it could actually be that maybe even another 0.5% increase will still not achieve anything, and we would actually be doing a lot of increases over the next couple of months. So if that's the case, then I think we better set ourselves up for just gathering more data and then trying to act again relatively soon.
Which is an absolutely fair point, and to the extent that we understand what that exchange rate that we wish to use as a policy instrument, that's also something I would like to get more clarity on, because there's some very good points made about USDC, and there's also really good points made about looking at the implied dollar exchange rate using for instance ETH to DAI versus ETH to USDC. But the underlying assumption, what Chris has pointed out, is that USDC should be sitting at 1 flat, but it doesn't. So there's that premium element that we need to consider as well. That being said, it really boils down to having a look at what we should aggregate and using some sort of weighting, what that policy rate should be. There's a lot of specific angles that we are putting forward right now, where everybody sees what they're seeing on the exchange that is important to them. But ultimately, what do we need to do in order to figure out an exchange rate that we can agree on and that is completely representative? So if anyone has an idea with respect to what sort of linear combination that we can use and what sort of weighting we should use and the reasoning behind it, that would be really great as well.
Well, we're seeing a question in the chat right now. So Marcin, sorry if I'm murdering your name there. VWAP, volume weighted average pricing, I'm thinking that's correct. Could be a good indicator. Do we have one for Oasis or ETH to DAI? So
there's a guy named, a little bit of a history lesson. Sorry, my apologies for this. There's a guy named Stadelmeier. He created seminal work on something called a point of control. So you had a time point of control and a volume point of control. And that is related to VWAP. And the thing with VWAP, to start off with, is it actually is a lagged metric. So you've got the problem of overcoming that lag and seeing how representative it is for a specific period. Now, that's all good if you've got a policy exchange rate that is commensurate with the time period that you want to have that you want to agree with as well. So if you want to get a 30-day representation, you have a look at a VWAP over 30 days. Another way you can do it is look at the sort of volume point of control, where you have a look every day where you have had the majority, theoretically speaking, of your trade being done, and then average that out as well. So you come out to more or less the sort of aggregate points that give you a representation of what that exchange rate could be. Anyway, so Stadelmeier came out with this whole idea, and the CME picked it up, and they've used it for the longest time. And it's actually quite a nice point to try and figure out what the real value attribution is to a specific instrument. In this case, we can use it for DAI, but still leaves us at the point of saying, well, even if we use ETH to DAI, which is great, how much weighting should we give to it? And even if we use VWAP, that's also great, but how much weighting do we give to it? Do we give it the full weighting? Do we need to combine it with what we see in Coinbase? Do we need to combine it with implied exchanges that we can figure out elsewhere? There's a lot of permutations we can use, but I think it's important for us so that we don't get strayed by the view that we see, but an aggregate view that we can agree on. And I would also say that this is the interesting part about this, is that those weightings could change moving forward. You might find that right now, Coinbase may have a certain amount of liquidity, but absolutely bolster its liquidity going forward, and majority of weighting might fall on them. You might find that ETH to DAI is really the place where we find all the liquidity. We need to figure this out. We need to be able to bring it together and say, okay, well, this is the policy rate that we should use. And when we see it, we come to these governance meetings and we can start discussing the metrics around it. And I do understand that this is a bootstrapping mechanism, and we need to try and figure out how to eventually get to the point where we have this management information. But I would like to press that question to the community and see what we can come up with, because I've got my own, once again, I've got my own perspective, that being the foundation has its own perspective, but it is always useful to get a more sort of robust argument from a group of folks as smart as we have in the community.
But Steven, could you start with just basically saying what you think about which ones you think are most important? So I think that's a much better start if you start with your perspective, basically.
Okay. Well, for me right now, I think that we need to get an aggregation of ETH to DAI midpoint, try and get a collection of data with that and see the implication against ETH to USDC. That's a nice implied rate. I put a weighting of about a third on that. I would also then have a look at the Coinbase Pro and probably put a weighting of about a third on that as well. And then, unfortunately, and this is not going to be terribly popular, but it's just in case one day they do have it right, put a third on what we see on CMC, on CoinMarketCap. Combine those together and create a policy instrument. There's so much room for error in that. I completely understand, but I think it's a good starting point to say, well, we've encapsulated the information that we've seen, and now we just need to adjust for some of the weightings in terms of how we rely on each of these component parts. So the first one is an implied rate. The second one is an actual one that we sort of put our flag in the ground and say, this is what we should be looking at. And then the third one is just trying to encapsulate as much information, because there's value in getting a lot of information. That's what CoinMarketCap has done. But we also know that CoinMarketCap has certain issues. So we can adjust for that later on.
In terms of pulling in information, I mean, DAI hardly trades at all against BTC, but BTC is the main liquidity provider to the crypto asset ecosystem as a whole. And so that's just something that comes to mind as a reference point, not because it trades against it, but just because it's such an important asset to the rest, to how so many other assets trade.
Mm. So we can convert that into an implied value that we can benchmark against. That would be great. And this is we're at the point now where we are, let's be honest, we're sort of scrounging for representation of value and then trying to figure out how we can bring it together to create a policy instrument. I mean, we are doing effectively what every major kind of, let's put it this way, federal or rather central bank struggles with. How do you get the collective information to come together to represent the value that you're seeing in a system? It's extraordinarily complex, but it's hell of a gratifying if you've sort of come to an agreement on what it should look like, and then we move forward with that. So Rune asked me what the initial stab at it could look like. I put the initial stab down. I've already seen a question about, from Marcin. I hope I pronounced that properly, or Marcin. he says, or she says, I don't know if we should look into USDC, USDT rates, and so on. I mean, it's a valid concern, but what is the suggestion on the back of that then? Because it's really a case of saying, where are the true pockets of liquidity that give robustness to the value that we're seeing, and how do we use that value to create an index for ourselves that we can rely on a little bit more?
Yeah, so I mean, I agree we shouldn't. Sorry, Rich. Anyway, I'll just finish my thought. I agree we shouldn't look into USDT, right? Because USDT really is kind of like manipulated and was traded and crazy and so on. But and the point you're making yourself, Marcin, right? Like, it's about looking at what is the real rate of one DAI to a real dollar. And USDC, I mean, it's the most legit centralized stablecoin, right? And on the very side, I mean, on Coinbase Pro, where right now USDC, or rather where DAI is being sold in sort of market making orders below $1, you can just directly convert USDC to USD. Like, it's just one click. It's exactly the same thing. Like, it's like, like USDC and Coinbase is like USDT and Bitfinex in a way, right? It's just really Coinbase dollars. So that's just why I think, I mean, it's, even though it barely has any volume and so on, it's like it's one of those places where we just know that if that one is out of sync, it's very unlikely that things are in sync elsewhere, because people would then be arbitraging through US dollar.
One thing to consider there as well, Rune, is like, I think that pair has only been up since maybe end of December, the DAI to USDC pair. Which would be one that would be great to look at. I mean, I would give that serious weight, especially as more volume goes through that pair. But then otherwise, we may, what's different here that we don't have to deal with when we're doing traditional VWAP and trying to think about prices in traditional ways where we go out with dollars and buy assets, is that very often, kind of going back to what Chris said, it's more of a graph, right? So I can go from dollars to BTC, BTC to ETH to DAI. And then we have to think about what is the highest cost path, what is the lowest cost path, what's the average cost for among the paths, and what weights we should give to each of those paths. It's a little bit of a different exercise than.
It's a great perspective. I agree with that. That's a really good perspective.
Look, I was going to bring that point up as well, actually, because it's very timely. So thank you for that, Alex. There's a great question in Reddit that maybe I'll read it out after the conversation dies down. But one of the points made was that is DAI simply worth 98 cents according to the market due to the risk inherent with the ecosystem, the stablecoins, and the path it takes to actually convert that into fiat or convert that into another currency that people are looking at. And the question in Reddit was, is 98 cents, 99 cents a realistic target until we have the DSR in place where we can start counteracting interest rates? And
so this is what someone also just mentioned a moment ago, right? And this is just like the answer, no, I mean, we can, it's the rate really is a matter of the stability fee and sort of the supply and demand of DAI, right? That's what sets the price. So there's just too many CDPs. It's pretty much that's what's causing the price to be lower. And if we increase the stability fee enough, it should have an impact. And I mean, if that turns out to not be true, we better find out sooner rather than later, right? I mean, if we keep increasing the stability fee now and the DAI price doesn't go up, that would be a very strange situation we've been in. So I think no matter what, I think it's really important that we kind of just act on what we're seeing and try to basically, especially more than anything else, sort of project the confidence that, don't worry, guys, it's going to be $1. It'll be possible for us to actually keep it at $1.
Okay, remember also that we're not dealing with a fixed trade where you can buy $1 million worth of DAI or USDC and there's no commission. I mean, right now with 1/3 of 1% as a taker, if you assume that on both directions, right? So that's a sixth of 1%. So, I mean, until they structure where you pay $2 and it doesn't matter how much you buy or sell, implicitly, just because they have a commission to get in and out, even if the world was perfect, you had stabilized the supply and demand of DAI and it was perfectly harmonized, you can imagine a scenario where it should be slightly lower until such time as it's just a fixed rate commission to get in and out. So I mean, right now, if you take like 1 minus the commission rate times 2, because you have to get in and out in theory, time, and you subtract what I just outlined minus the current traded price, it's a little bit less than 1% off, whatever, 0.008.
Yeah, and this is, I mean,
Yeah,
this is absolutely true. And I think in a way the key takeaway is just always that things are more complicated than just a price, right? It's really a lot more complex than that. But the counterpoint to what you're saying is that I think when you look at something like the USDC against DAI order book, right? Then it's true. Like then the taker fee, which is I think 0.3%. It's true that means that you'll never be able to buy DAI for $1 there, right? But what's important is the midpoint should still be at pretty much exactly $1. And in particular, it's just definitely something is wrong when you have people sort of placing, like limit orders sitting on the order books below $1, right? That really shows that even on a longer term perspective, people are actually valuing it below $1. And you're not just talking about kind of like the cost of liquidity or, yeah, right. Like, I mean, that is just because someone needs to do some trade fast. But so another point I want to make is, I think so. It's that like eventually we absolutely do need this kind of like very sophisticated, right, point of control and kind of like basket and really like sort of this number that we sort of produce, and we basically take this number and we say this is the price we're currently observing in the market, and then based on how far that number deviates from $1, we know what magnitude of adjustment we need to do this week, right? And this is how I envision the DSR is controlled once it's live. And then every single week we do a tiny adjustment. Some weeks it's going to be bigger than other weeks, right? Depending on basically how much the market sentiment has moved. But I think in the short term, I think another like useful way to look at things is also just to kind of like just get the general gist kind of the market in a way. So we don't actually need to be too precise, because we don't need to conclude how much, like how big the imbalance is. We just need to conclude whether it's currently below or above, right? Like it doesn't, like, we don't need to know if we have to do an increase of 2% to get into balance, or if we only need to do an increase of 0.5% to get into balance. Because if we just say we do 0.5% changes every time, then all we need to know is whether do we increase it or do we decrease it or do we do nothing, right? And then and a way I think that we can look at that is to, rather than think of it as of combining all the data points and sort of making a virtual average. That is super useful, and I think we should do that as soon as possible, kind of. And it's just always going to be really incredibly useful to have that. And the sooner we get started with it, the more evolved it'll be over time, right? So it's better to get that going as quick as possible. But another way to look is just to see how many of kind of like the different signals are pushing on, like, are sort of like showing, are sort of in agreement, right? So it could also be, instead of saying that, so it could be like, let's say, if we look at the virtual, or like the implied ETH DAI price, for instance, we can conclude that's below $1. If we look at the DAI USDC price, we can say that's also below $1. If we look at other data points, like the inventory levels, right, we can see they're too high. And then we can look at, I don't know, other, like a bunch of different sort of indicators that on their own, you can't use them to say how big, what magnitude there is imbalance, but you can use them to say whether this indicator is saying the imbalance is, up or down, basically, right? And then the more of them are in agreement, so the closer you are to sort of a consensus, the more certain we can feel about moving the stability fee in a particular direction, even if it doesn't tell us how much to do it.
Let's put it this way. What we've done now is we've kind of made arguments with all other things remaining equal. And what we really need to do is we need to try and get the information that tells us how diversified the supply of DAI is, and at the same time how diversified the demand for DAI is. That is ultimately what we really need to do. That's going to inform us, because if we get a sense that that is generally well balanced, then anything that goes out of kilter can be, to the most part, rebalanced again using a stability fee. But because we're bootstrapping, we have to ask ourselves a question of, what does this information look like, and what does it say in terms of the effectiveness of a stability fee right now? To that end, I think the stability fee does have a contributing factor, but to what extent, not terribly sure. If you have if you have a look at a simple case of what is it now, there's about 1.9% of ETH that's in CDPs, and if ETH starts going on a little bit of a bull run, everyone's going to have more value in their CDPs. So what is the option available to them? The option available to them is either do nothing or extract more DAI from their CDPs. I mean, that alone gives you a supply route, and that's got nothing to do with the stability fee, unless, of course, the increase in the value is somehow commensurate with the stability fee increase. Now, that is a completely different kettle of fish. But essentially, if you're sitting at 1% and folks are saying, well, no, I've now got 40, 50% more available to use at 1%, maybe I shall go do it. Maybe even at 2.5%, people will still think maybe to go and do it. So there's an element there where you can immediately see, just from ETH increasing, you've got this cost-benefit analysis of saying, well, how much does that stability fee really affect just those people with CDPs right now from actually extracting more DAI? And that is one small argument. Now we've got to balance that off appropriately with, do they extract it because there's a demand function there for them to extract it on? Or do they literally just want to take DAI, convert it into dollars, and use it in the traditional world? So that's where the demand function really needs to be explored a lot as well. But to the end that we don't have that information, we need to really look internally and assume that we are at a specific level of development where we're still trying to get more information about what the stability fee is going to be doing for us.
So here's a question, and it kind of dovetails into what you were just saying. I think the supply-demand imbalance that we're all talking about, exactly your point. If Ethereum, and it's a single collateral world, if Ethereum were to rally up, double, triple its price, do something crazy, people would borrow more to do whatever they want to do with it. The question is not whether or not they'd borrow more per se, it's really what would they do with it? Would it stay in blockchain world or outside of blockchain world? If they decide to go buy a car with it and they send it over to Coinbase Pro and sell it immediately and drive the price lower, I mean, the real question, is there a way we can aggregate our data? And this is not me saying with authority, it's just a question, like aggregate our data of literally the on-ramps and off-ramps, the aggregate in and out, because that's really, in my mind's eye, the real supply-demand imbalance is whether or not we have a net in or a net out of DAI. That's more money coming in the system or out.
Let me make sure that I understand that point, because that's very interesting. Isn't it also a function of the utility of DAI within the ecosystem, though, right? Like, people are locking this up. They're buying nifties. They're playing games. Wouldn't that serve the same purpose? Why is there an emphasis on leaving the blockchain?
There's also a rate of inclusion and attrition as well, going in and out. If you find that over the course of the blockchain developing as an economy itself, the amount that actually off-ramps might be reduced to something insubstantial. So, but what I think the general point that Matthew is trying to make is that, if we do find a world where there is an ability to get some sort of metric from on-ramps and off-ramps, where we are right now, because let's be honest, I think Mr. Padovano just mentioned about lending desks and what they think about DAI. You're sort of going into the world of fiat-backed stablecoins, and you're saying, well, let's pretend we're one of them because gee whiz, they're so good. Now, it's your choice, it's your option as to which type of stablecoin you wish to choose and for what reason. If you believe centralized stablecoins are the way forward, then by all means go for it, because it suits you now and it suits your understanding of it now. But as soon as you develop into this world where it becomes very clear, decentralized stablecoin that is very transparent on blockchain, you will want to keep your stablecoin on blockchain. You won't want to use it as just a mechanism to go from dollars to dollars, because effectively that's what the fiat-backed stablecoins are pretty much saying right now. And to the extent you wish to have them on chain, you're thinking, okay, well, what's your exposure? Your exposure is to this central dark place that you don't know what's going to happen tomorrow. And if anything will inform us on that fact, I'd say most of the crypto space has been developed off the back of the inherent disbelief that central parties can actually look after us in the long haul. So I think there is something to be said about trying to figure out on-chain while we're bootstrapping to find out where we can get these sources of value to inform us as to where DAI is. And what we're going to find is that organically it's going to produce a mechanism that's going to become very clear as to how that's going to inform us about the supply and demand, something that also will be extraordinarily transparent. And to the end that it serves the purpose of being the de facto store of value on the blockchain. Again, it's going to be part and parcel of the development of this economy on the blockchain as well.
So I just want to, just to your point, Rich, right? Why the on and off ramps are so important, so right? I mean, that is really because what we try to control for is the price, right? So it's so the internal utility of DAI and so on is yet another indirect factor that impacts the price, just like the price evolution of ETH and other collateral and so on. And then just the thing that's so important, I mean, that everyone that I hope everyone understands already, and that just really is kind of like the fundamental thing that that we're working with, is that the only thing we have to, when we see whatever data we see about what's happening with ETH price, what's happening with on and off ramp, what's happening with DAI utility, what's happening all over the place, and how is it reflecting itself in the ability of someone to trade large amounts of DAI in and out of US dollar, or rather large amounts of US dollar in and out of DAI, or however you want to see it. The only effect, the only way we can change that, we can sort of affect this in any way, is by right now adjusting the stability fee, and then later by adjusting the savings rate. And then that's also why I think, and because there are so many factors, right, and especially in the short run, these factors are going to have a huge impact compared to, let's say, small stability fee adjustments. That's why I think basically we need to do, the more often we do adjustments, the better. And sort of the better we get at doing very granular, small-scale adjustments and just doing them more often based on real-time data, the better stability we'll end up with, right? Because we'll be better able to continuously and instantaneously react to the market conditions changing. So yeah.
I think I just want to push back on that a little bit, because I think that there can be, I think from a granularity and sort of adeptness of the technology perspective, it really flexes makers' muscles, say, to be very adaptive. But then sort of from a market confidence, and this really depends on who's going to be using DAI, it can appear erratic, right? And so there's kind of this balance between what we can do and what we're capable of, which is always superior to the existing systems, versus how that influences the overall psychology of the market. So just keeping those two in balance.
That's a messaging thing than fundamentals.
Well, Chris, yeah,
Right.
That's an interesting question that keeps coming up, and so maybe you can provide some insight. Whether is it a matter of us just presenting the fact that CDPs have a variable rate, and that's just simply the way things are, and that's what people should expect, and that handles the perception issues, or do you feel that this actually creates a roadblock for a certain segment of our users, where it becomes untenable to not understand what the stability fee will be in the future?
Sorry, I just want to jump in. Sorry.
Go ahead.
Because I think, I totally agree, right? But I think there's only one legit solution to this, and that is to create a market for interest rate swaps, right? That's because that's what regular people want, is they want an actual guarantee, and they're really if you want the absolute most efficient, sci-fi interest rate, you have to accept that it's going to be variable, right? And highly variable, in fact. But then you can people can specialize in kind of bridging that usability gap, right? By accepting the variable rate, and then providing a fixed rate.
Right. Okay, that makes sense. Where the protocol layer, I mean, ultimately the protocol layer will be buried beneath different application layers that strip out the volatility for different users. So that makes sense to me. I think that, you know, when I was hearing you guys go back and forth on the price being set through the on and off ramps versus, say, kind of the people who derive core utility from DAI. For example, I mean, we're seeing DAI increasingly, and I think this is just going to become more and more the case, be used as collateral within DeFi. And that I feel like is one of the most exciting core drivers of utility of DAI, aside from, you know, traders using it and how it's priced. And so I don't know how to weight those two because, you know, if you increase the savings rate or the interest rate of DAI, I mean, how does that then affect how people are using it on Compound? And I feel like we wouldn't want to leave out, you know, the Compounds or the Augurs or the UMAs as they're using DAI as collateral just because they're not critical to the setting of the price of DAI.
It's interesting. So you're concerned that the DSR might unintentionally turn MakerDAO into a competitor for the rest of the DeFi space that we're looking to sort of integrate with?
Yeah, because they're going to drive core demand, and right now we have more of a demand problem, right, for DAI than a supply problem. And so making sure that just because they're not critical to setting the price day to day in the market, that they're not forgotten because they're sort of this secular long-term demand driver.
So I think that's good. I love that.
I don't know that your microphone's working, Rune.
Yeah, I think we've lost you.
Works?
No.
It's I think lost you. Again?
Actually, I heard him there at the end.
Nice. Not back in.
One other thing there is, I think so. We've seen how DAI works in bear market, right? So we've seen how DAI works when ETH price is really being drawn down and contracting in a big way. And now we're starting to think about how we quantify our reactions to those types of events, as well as external events in the broader environment. What we really haven't seen, and this goes to Steven's point earlier, like, we haven't seen what happens in an expansion of ETH price. And in particular, we haven't seen that where potentially DAI isn't just used in its current form, but also serves as collateral for other applications that could provide additional leverage or additional financial complexity within the system, right? So let's go back to Steven's example earlier. Let's say ETH price increases substantially, CDP holders draw more DAI, potentially they use that DAI to collateralize other contracts that make more sophisticated bets on ETH price and create more. So those kinds of things are things where potentially we could have an idea of DAI price, and maybe that's our true north, but maybe sometimes that's really causing us to lose focus on what's actually happening in the underlying. And so I guess maybe it's a long-winded way of saying we could maybe find ways to think about how to measure ETH, how to measure DAI value today based on what we've seen in the DAI economy over the last year, but to what extent are those things applicable to different and sort of broader crypto macroeconomic environments where potentially we see an expansion in ETH price and increased financial complexity within the DAI economy.
So, can you hear me now, by the way?
Yep.
Yes.
Okay, so I have a point I feel really strongly about. I think something I think is really important that it's a much bigger topic we can get into more later and so on, and it's sort of a part of the whole whatever the natural, like where this project is supposed to go, right? And it's a little bit related to what you said, but particularly also what Chris you were just talking about, right? And really, it's the fundamental question of like, what is really the point? Like, what is the point of kind of like we're messing around with the DAI savings rate? What are we trying to achieve with it, right? And in a way, you could always argue that when you do sort of governance over a product, the goal you're trying to achieve is kind of like maximum. You're trying to make things good for your users, right? That's always the point. so in a way, it's kind of like, in a way, the ideal question for how to change the savings rate is kind of like asking everyone, being like, what's best for you? And then figuring out some sort of utility composite thing, right? And like make the optimal choice. However, I mean, that's impossible, first of all, right? But the second thing is also that really, I mean, the way you sort of even, the point of, especially when you talk in the context of stability, right? And so on, the point is really, you know, certainty, and kind of like stability kind of means no surprises, right? It kind of means, it means, you know, you can count on you know, you can count on DAI to be governed or whatever, right? I mean, to provide what it's supposed to provide. And anyway, so that's kind of like the core thing I think is super important, that needs to always be the most important thing for us, is that the promise of DAI right now is that it's a stablecoin is pegged to $1, right? And that means something like and us achieving that in the best possible way means that we set our interest rates in such a way that you can take as much DAI as possible, and you can turn it into, you know, as close to $1 per DAI as possible, right? At least, I mean, I think, I mean, and then of course there's also like, this has to be geographically distributed, and there's sort of like, it means something different to every person and so on. But I just think that it's very important that we're very clear about that. Basically, our goal is to stabilize DAI to $1, and you know, and that's how we set our interest rates. And an alternative that we then need to consider for the future is like all these other options there are for how do we decide what our goal is for the governance, right? And one like easy examples to go for the synthetic assets, right? I mean, we also want to stabilize around euro. We also want to stabilize around synthetic assets, gold, and so on. And in the future, one day we could even have something where we actually do how many central banks set their governance, which is a little bit more, you know, it's actually more, I guess, in a way you could say personal in a sense, right? Because what you really do is you don't just like try to target an exchange rate. You actually like try to like fulfill your dual mandate, right? Of like improving the economy, and which doesn't necessarily always mean that you exactly want to target some particular exchange rate, or you exactly want to blah, blah. You actually go and measure it, like what are your effects on the unemployment rate and so on. So I just think, I mean, so that's something that can really be explored a lot. But for that, like for now, in the short run for DAI, there's not really a discussion about what the goal is, right? The goal is to peg it to $1, right? And we can discuss what that means. But one thing is for sure for me, and that is at least that $1 means like $1 in a bank account, like, you know, real US dollar in a real bank account. And that's always what's kind of the measure of success, or kind of like the thing, like that's the definition of like peg to $1.
Well, so something to consider in terms of just like history related to what I was mentioning about the on and off ramps is somewhat the history of Bitcoin and how it was used in China in a capital controlled environment, and how many argued that you're transferring a Bitcoin, you're transferring value from, you're converting yuan to another exchange that allows the purchase of yuan that then sends a Bitcoin out of the country. And part of the arguments of the then exchanges were, we're not violating the capital controls because the yuan is actually not leaving. Now, the yuan at the time, maybe it still does, had whatever X peg. It's not 1-to-1, but it doesn't matter, make it 5-to-1. The point ultimately that the Chinese central bank came to the conclusion was this was causing a value transfer, that even though the currency wasn't leaving the ecosystem, the value was. And that's the point I'm trying to get at, why the on and off ramps are so critical, because while the value is contained inside, you know, it all just turns into one. But when you've got a flood of capital that exits, if we have a huge price increase, when multiple collateral DAI shows up and all of a sudden there's an entire capital base, a collateral base that never had a liquidity source now does, and a bunch of guys who own, I don't care, whatever it is, Augur, decide they want to buy a car, you know, they're not going to do it with DAI. They're going to exit that, which is going to put it's going to directly put pressure on what we're talking about. The question then becomes, you know, balancing all that. No, without going off into some other tangent, you know, the question also is, at some point, if you use USDC as a collateral, whenever that's possible, is there not a trade that can construct that allows us to, in effect, short USDC and then buy DAI and buy it at leverage to then cause it to move back to one? Can't we use a market making function?
Just to answer that question, I mean, what you just described there, using CDPs directly in this way, short USDC through some sort of core mechanism isn't possible. But it is but you can short DAI, right? And you can have you can facilitate, like by accepting USDC as collateral, we can facilitate massive unramping from USDC, and then of course a sort of a rebalancing out again, because once a market maker is heavily levered up on USDC, he can very easily accept DAI and give USDC in return, because he can use that to basically deleverage again. So that's also, I mean, so just like the last point, whatever with that, I mean, which was also basically what I started with, is I think USDC in particular is quite important for us, because it's really what we have available to us in the short term to actually try to create this like true, strong, like, I mean, it's always going to be a soft pick, but like a strong soft pick, right? Where it's like you can actually take millions of dollars of DAI and you can convert it out into real dollars in a bank account. And even if you do, let's say 10 million or 100 million in one go, you should be able to do so with relatively, or like, you know, like almost no spread and almost no slippage. And it's, you know, and it should be possible as long as the savings rate is set correctly and we just have enough ecosystem participation, and then we have USDC as collateral.
It's as close to a treasury as we're going to get for right now.
I also just in general really think that, you know, I mean, this has been the sort of the general idea for a long time, right? That like the stablecoin, like all the centralized stablecoins really are this super important and sort of impactful ecosystem for us. So I think, like, if we start with USDC just because, or like, I mean, we focus on USDC at first because, I mean, we have a DAI USDC market and so on. And also we have a relatively known sort of pathway to using it as collateral. Then that's just, I mean, that's just a good starting point for a future where we actually use like many different centralized stablecoins, right? And we sort of use them as the closest proxy we can get into real dollars in a real bank account, right? As long as we can measure and verify that they do have that very strong convertibility, right? So for instance, Gemini is a funny example of how recently there was some controversy where even when they say they're totally fungible and it's totally $1, it's not even completely clear that that's the case at large volumes. And USDT is, of course, the most obvious example of how it doesn't really mean that much at all, and it's kind of totally arbitrary.
All right, well, we have 1 minute left, so I don't know if we have time for any more questions. There's a lot to absorb from this call, though, so that was good. I think I'm going to take a rewatch of this one. Rune or Steven, did you have any last thoughts you wanted to leave us with, or can we wrap it up?
I think the one thing that's become particularly obvious in all our discussions is that we're actually talking implicitly about the best way to bootstrap MakerDAO into critical mass and with the sort of momentum that helps build this on-chain economy that we're looking for. There's an implicit idea from looking at the use of DAI as collateral in other systems as a very good point of argument, as that may be sort of your initial use case, which allows you to get the critical mass that you require. The other is to also consider the simple notion of looking at merchants and vendors, goods and services that accept and transact in DAI. So that broader aspect will then inform us what the demand function will look like, and then it'll further inform us as to what sort of stability fee and what DAI savings rate we need to use and when we need to use it. So, you know, keep in mind that what you guys have seen, what you guys have spoken about, clearly is much broader than just looking at the stability fee in a sort of caged environment. And, you know, for that, thank you very much for recognizing that, and also thank you very much for contributing.
That's a great point to leave us on. So yeah, thank you, Chris, Matthew, and Alex, for the excellent questions. They were very insightful. Thank you, Rune, and thank you, Steven, for shepherding us through this process. I'll be posting this to Reddit soon. It'll be going up on YouTube, and look for a link on Twitter to our SoundCloud if you want to listen to it in transit. All right, thanks everyone. Talk to you next week.
Thank you, everybody.
Thank you.
See you guys.
Bye, everyone.